Can a country simply print its way to prosperity, only to find itself drowning in worthless paper? This is a question that cuts to the very heart of how we understand money and wealth. Many of us hold a simple image in our minds. A government short on cash fires up a massive printing press, churning out endless sheets of new banknotes. This idea, the money printer, is powerful and intuitive. It's a story told time and again to explain why prices for everyday goods can suddenly spiral out of control. It suggests a direct mechanical link between printing paper and losing value. The truth, however, is far more complex and fascinating. While physical printing does happen, it represents only a tiny fraction of how new money enters our world today. In our modern interconnected financial system, the creation of money is predominantly a digital affair. It happens with keystrokes in the computers of central banks and commercial banks, creating electronic digits that flow silently through the economy. This essay will demystify this process. We will journey from the popular myth of the money printer to the intricate mechanism of modern money creation, exploring how it works and, crucially, why an overabundance of it can lead to the painful reality of inflation. This story is not just academic exercise. It is fundamental to understanding the economic headlines that shape our lives, from debates about government spending to the rising cost of our weekly groceries. So, if it's not just about printing presses, how is money actually created? The process begins not with paper, but with a decision. A government determines it needs more funds than it collects in taxes, build new hospitals, pay public sector salaries, manage existing debts. This decision sets in motion a chain of events involving the nation's central bank, the ultimate authority on money. The central bank has two primary tools at its disposal. First, printing new physical banknotes. Second, minting new coins. This is the tangible, visible part of money creation. The far more significant method is creating electronic money. A central bank can, with a few keystrokes, create new digital reserves. Not cash you can hold, electronic entries in commercial banks' accounts at the central bank. Think of it as the central bank increasing the number in its own spreadsheet. That digital money becomes the foundation for banks to expand the money supply. We often shorthand all this as printing money, even when no ink touches paper. Imagine a village that makes exactly 100 loaves of bread each week. The village has $1,000 circulating, with $1,000 chasing 100 loaves. Each loaf costs tens. How does this newly created digital money, existing initially only as entries in a central bank's ledger, make its way into the hands of ordinary people and businesses? This journey happens through several key channels, each of which injects liquidity into the broader economy. One of the most direct routes is through government spending. The central bank can credit the government's account with new money, which the government then uses to pay for its expenditures. This includes paying the salaries of teachers and soldiers, funding large infrastructure projects like roads, bridges, or distributing social welfare benefits. When people receive these payments, the new money enters their bank accounts and begins to circulate. Another critical channel involves the commercial banks, the high street banks where we all have our accounts. The central bank can lend newly created digital money to these commercial banks at a specific interest rate. This encourages them to, in turn, lend more money to their own customers. When a business takes out a loan to expand its factory, or a family takes out a mortgage to buy a home, the commercial bank creates a new deposit in the borrower's account. This act of lending itself creates new money in the form of bank deposits, expanding the money supply even further. What happens when the creation of money spins completely out of control? History provides us with stark and cautionary tales. One of the most infamous examples is the hyperinflation that gripped Weimar Germany in the early 1920s. Following the immense financial burdens of World War I, the German government resorted to printing vast quantities of its currency, the Reichsmark, to pay its debts and war reparations. The central bank's printing presses ran non-stop, churning out banknotes with ever higher denominations. This flood of new money completely overwhelmed the country's productive capacity. The consequences were devastating and surreal. Prices rose at an astronomical rate, sometimes doubling in a matter of hours. Workers demanded to be paid multiple times a day, rushing to spend their wages before they became worthless. A loaf of bread that cost a few marks in the morning could cost thousands by the afternoon. The currency lost all credibility. People used stacks of banknotes as wallpaper, kindling for fires, or even as building blocks for children to play with. The money had become cheaper than the goods it was meant to purchase. This episode demonstrates a profound truth. Once trust in a currency evaporates, it ceases to function as a store of value or a medium of exchange. A more recent but equally dramatic example comes from Zimbabwe in the late 2000s. Prices were rising so rapidly that official statistics became meaningless, estimated to be in the billions of percent per month. Given the catastrophic potential of runaway money printing, how do modern economies prevent history from repeating itself? The most important safeguard is central bank independence. In many countries, including the United States, the United Kingdom, the member states of the Eurozone, the central bank is designed to be operationally independent from the day-to-day political pressures of the government. This separation is crucial. It means that politicians who might be tempted to finance populist spending by printing money cannot simply order the central bank to do so. These independent central banks are typically given a clear mandate to maintain price stability. To achieve this, they have a sophisticated toolkit at their disposal, which goes far beyond simply turning a printing press on or off. Their primary tool is often the policy interest rate. By raising interest rates, they can make borrowing more expensive, which slows down lending and causes the economy to keep inflation in check. Conversely, by lowering rates, they can encourage borrowing and spending to stimulate growth. This allows them to fine-tune the economy with much greater precision than the blunt instrument of printing money. Another powerful tool which became prominent after the 2008 financial crisis is quantitative easing. During QE, a central bank creates new digital money to purchase financial assets, usually government bonds from commercial banks. This action increases the reserves of the banking system and is intended to lower long-term interest rates, encouraging lending and investment. If creating new money can be so dangerous, is it always a bad thing? The answer is no. The relationship between money supply and inflation is not a simple one-to-one equation. The impact of new money depends heavily on the overall health of the economy and the condition of the economy at the time it is introduced. Not all increases in the money supply automatically lead to runaway price hikes. In a growing productive economy, a modest increase in the money supply is not only harmless but necessary to facilitate the expanding number of transactions. As the economic pie gets bigger, more money is needed to buy and sell these additional products without causing prices to fall, a phenomenon known as deflation, which can also be damaging. In this context, a central bank can allow the money supply to grow in step with the economy's productive capacity. The new money is absorbed by the creation of new value and prices remain stable. The key is balance. The growth in money should roughly match the growth in real economic output. Furthermore, during an economic downturn or a financial crisis, creating new money can be a vital tool for recovery. Actions like quantitative easing can provide much needed liquidity to the financial system, preventing a complete collapse. It can help restore confidence and encourage the lending and the investment needed to restart economic growth. The goal here is not to create inflation, but to fight the powerful deflationary forces of a recession. So, what are the enduring lessons we as citizens can take away from this exploration of money and inflation? The first and most important is to maintain a healthy skepticism of simple solutions. The idea that a country can solve its problems simply by creating more money is a dangerous illusion. True wealth comes from production, from innovation, from the creation of valuable goods and services, not from the printing press or a digital ledger. Therefore, we should pay close attention to the relationship between the growth of the money supply and the growth of the real economy. When money consistently grows much faster than output, it is a clear warning sign. A second practical lesson is the immense value of trust. Money works only because we collectively believe it will hold its value tomorrow, next week, next year. This trust is fragile. Once it is broken, it is incredibly difficult to repair. We should watch for signs of eroding confidence in a currency. For governments and policymakers, the power to create money must be wielded with extreme caution and discipline. It is essential to foster an environment that encourages real production and economic growth rather than relying on monetary shortcuts. Crucially, this means respecting the independence of the central bank and its mandate to keep prices stable. Finally, let us end with a thought to carry forward. If money is ultimately a social construct, a system of trust represented by paper and digital numbers, what does its stability say about us? The stability of a currency is often a reflection of the stability of the society that uses it. It reflects the prudence of its leaders, the productivity of its people, and the strength of its institutions. Understanding the real story of money beyond the myth of the printer helps us become more informed citizens. It empowers us to hold our leaders accountable and to appreciate that sound money is the silent, invisible foundation of a prosperous and stable society.